For more movers, let's welcome in Diane King Hall now, who is the host of Morning Movers. And you're watching a couple of stories today. And what are they?
CoreWeave.
CoreWeave.
We're starting out with CoreWeave. Hey, listen, you feel my pain essentially behind the scenes. What you guys don't know is you see, us do this turnaround from anchor to anchor, show to show, and there was a sharp turnaround today. So I have an injury as a result of that. So I think Sam's mind is on making sure I'm okay. I'm okay. CoreWeave's not okay this morning, though. Shares are off by nearly 2% at the moment. This comes on the back of some downgrades. It's getting a downgrade by Mizuho to neutral from outperform. That's about some valuation concerns. Look, the stock has skyrocketed since its public debut. It raised its price target to 150. That's up more than double from where they had their price target, but essentially it's around where it is now, right? So Stifel, though, also downgrading the stock. They've downgraded it to a hold. They're moving to the sidelines as well. They've also boosted their price target, but it is lower than where it is now, so that suggests some downside risk here. Their price target is 115. They also had a similar price target previously of 75 to Mizuho, again, a little higher than where Mizuho's was, but lower than where Mizuho is going now. Stay with me here. You've also got other recent analyst activity around it. Not today, but Macquarie, Barclays, they're neutral sidelines on CoreWeave. That's pretty common with a younger company, especially when you don't know, you don't have this long-term performance to gauge it. And look, they point out that valuation is a stretch. They're trading at a premium, signaling just high investor expectations. The stock is up almost 300% this year since its IPO, which was just a few months ago. So they just think that the risk-reward situation now is balanced, even when you take into account this acquisition they're making of CORZ Scientific. They announced that acquisition yesterday, although there was a report of that before it came in the Wall Street Journal previously. It was a $9 billion all-stock deal. That didn't CORZ Scientific. Now, to be fair, Mizuho still sees this acquisition as strategically positive, Sam.
Yeah, it's interesting, isn't it? Because when you talk about those valuations, it seems to be a phenomenon within the sort of AI space. But it's interesting because you need that infrastructure.
You do need the infrastructure, and that's a big part of why CoreWeave has rocketed higher. I mean, look, in terms of, again, the positives, because when you have these analysts go equal weight, they point out the positives and the negatives. It's a very balanced take. The positives, they think in terms of the benefits of the deal, you reduce some lease overhead. They see that being reduced over the next more than a decade or so. Basically, you have some cost savings because of, just often two or greater than one, because you reduce some headcount essentially. And then they think it also gives them a stronger market position in AI infrastructure because it's two AI infrastructure providers there. So there's just, it shows that there is still demand and appreciation for AI compute infrastructure there. CoreWeave balance off of that. But again, they point out CoreWeave just trading at expensive levels, Sam.
Ryan, switching gears, obviously we've seen HSBC downgrading a number of the banks. It's interesting because as we head into the earnings season, obviously this is the first sort of cohort that we're going to be hearing from. So what are they saying over there? It's
so interesting, and this reminds me of a conversation I had with Larry McDonald yesterday, which you know Larry well, Bear Traps report creator, and he was predicting, some weakness in the banks as well. So HSBC seeing similar kind of view. They're cautious on the banks. They're downgrading three banks: Bank of America, Goldman Sachs, and JPMorgan Chase. They're just citing stretch valuations after the strong run-up that we've seen in their share prices. They still think their fundamentals look healthy, but they see limited upside from here, and just that the risk to reward is no longer as attractive as it was. So let me go through the list of them. Bank of America, they're downgrading it to a hold from a buy. Their price target on Bank of America is actually raised, though, increased. So it's like, when analysts do this, I feel like they're kind of playing both sides sides of the fence here when they downgrade to a hold, but then raise their price target. So their price target for Bank of America, $51 a share now. Bank of America feeling the heaviest pressure off the back of this move, down nearly 2% right now. Again, they see limited upside from here because although it's down about 2%, it's up more than 8% year to date. So it's not the strongest performer. Obviously, JPMorgan Chase has been the strongest performer, outperforming the S&P 500 this year. JPMorgan Chase, they've downgraded it to reduce from a hold. They have raised their price target, though, to 259, which to them, if you read through, it's at 286 now. That suggests some downside from here. They obviously see JPMorgan Chase as well run, but they just think that shares have run too far too fast, basically. And they think that the risk-reward setup does not look favorable right now for JPMorgan Chase. Want to get to Goldman as well. They've downgraded it as well from hold to reduce. Their price target, though, they've increased. Once again, in my view, playing both sides of the fence here. Now, their price target increase, though, still lower than where it is now. Their price target increases, they've increased it to 627. Right now, it's above $700 a share. Year to date, it's also been a big outperformer compared to the S&P 500, up more than 20% year to date. Again, they do not see worsening fundamentals, Sam, but again, it's that story of too far too fast.
Yeah, absolutely. It's interesting because I think it was probably about a year ago from now where we were sort of talking about some of these earnings coming from some of these big banks. And I remember analysts sort of suggesting, don't look at what's happening now, sort of look to medium to long term. And that's probably, where we're at.
I think so, yeah. And look, to be fair, if the banks outperform this earnings season, because again, the previous quarterly earnings season was better than expected, if they continue to outperform, this is a bad call, essentially. And so, for instance, with Goldman, the analyst saying that unless there's a sustained pickup in investment banking in IB or markets, which it's possible, we could see more volume in the numbers when they report their numbers, they think that the stock could disappoint and then see a pullback. So, we've got the earnings season in front of us. What they do say, what HSBC says instead of these big banks, is they're more constructive on the super regional banks. So those mid-sized regionals, they see some potential, which that lines up with what Larry talked about yesterday. Yeah,
interesting, and obviously staring down the barrel of a potential number of rate cuts, let's see, throughout the rest of the year into next year. And just lastly, before we let you go, Capital One, TD Cowen now upgrading to buy. So talk us through that.
It is, and its shares are a little higher today. It's also been an outperformer compared to the S&P 500 year to date, up more than 20% year to date. So TD Cowen upgrading it to a buy from a hold. They've raised their price target to 258. So that obviously signals some upside from here today, trading just below 220 right now. This is both strong performance, so just fundamentals here, and then they see long-term upside from that acquisition of Discover. They see it now. They see this deal as a game changer here, essentially, Sam. They point out that what Capital One owns now with Discover is a payment network. So that's a valuable asset. And they point out that this is rare now in the financial space, especially when you see, so much moves towards like more of a fintech. So they think that justifies, or it could essentially justify, a higher valuation for Capital One. And even though Discover, for instance, doesn't have that strong international footprint, they think that Capital One has better execution, and with that acquisition, they can unlock more value over time with this acquisition. They do say this could take time, right, Sam? So the benefits may take some years to fully materialize because, there will be some shifting of cardholders to the network, and whenever there's a merger, it takes time, or acquisition, it takes time to integrate and create a new sum of the parts here. But they point out the track record of Capital One. They're successful credit card issuer, and they're gaining market share and outgrowing their industry peers there.
Yeah, interesting. I mean, that's certainly implying a quite considerable upside there at 258, isn't it? Thank you so much, Diane. I hope your pinky finger is okay.
It'll be fine.
Anchoring is an extreme sport,
Tough
I tell you what.